So we're talking about a bunch of stuff today, but inflation's kind of on everybody's head right now and everybody's mind at the moment. Everybody continues to just kind of talk about it and it continues to get brought up and it's kind of interesting. I think it's like inflation denial right now. I hate to use that word, but it's almost like inflation denial. Like people are like there is no inflation, everything's fine, and it's like if you live in the real world, you have to see that like there has been inflation this whole time. Tradable inflation, yeah, that hasn't happened for a little while, but that's been picking up, and really this year it's been picking up a lot. Things like cocoa have been absolutely insane, just out of this world trade at the moment. Um, and then you get into things like oil, and oil's been raging. Basically, what did we start the year around $60? We're around 85 now. Um, we continue to just have these rallies across the board in all these different commodities. Gold is hitting all time highs. Silver is catching up to it. Copper is looking good. All of these things that we continue to see that people were saying, hey, these aren't going to come back. You got to start buying this. Hey, tech's going to go up forever. When you start to hear those things, you have to think a little bit differently. So today, Kashap is on and a perfect person to talk to about this stuff because I want to talk to him about how he's positioning himself. What are you buying? What are you looking at? What are you thinking about right now?
So I'm positioned across the entire commodity complex because I think once inflation picks up, we're going to see something like what happened in 2021-22 repeat, and it's not going to be pretty. But I mean, that's the thing about trading, right? Like you go to the supermarket, and so today I went to the supermarket and we ended up spending 50% more than what we would normally spend on our monthly groceries. And that's not fun. But then when you look at the markets and it's like, hey, gold is going up, copper is going up. So, you buy the miners, you have the leverage to the gold price, the copper price, the oil price, and then you're like, okay, now you feel pretty good. And it's kind of two different aspects to it, right? One is you're trading the commodities, and the other is you're buying them for your personal use. And in the trading part, I think is just going to everything is going to shoot higher. And the main reason for this, ironically, is the Fed rate hikes. So what the Fed rate hikes did, so it didn't matter for tech, right? All these tech companies, Apple would have like $100 billion of cash on their balance sheet. They would earn 5% interest on that. So they are actually doing pretty well with high interest rates because they are earning the interest. And it's all these commodity producers who have, like, you have $1 billion of equity, you have probably $3 billion worth of debt, and these guys are screwed because they have to refinance at higher and higher rates. And what happens is it's a movement of profits from the shareholders to the bondholders, because whatever pre-tax, pre-interest income you make, most of it is now going to the bondholders, less of it is going to the shareholders. And in this environment, what do? You cut spending. So you cut spending on exploration, you cut on maintenance capex, you cut on growth capex, and what that does is down the line, commodity prices are higher because everyone's cut production, but there is no new supply coming online, and that just makes the problem even worse. And that's where we are today. And we are in that situation with interest rates still at 5.5%, and the cost of debt for a lot of these companies is at 10% plus. And so you have a situation where even though they are starting to make money, they are not going to invest in capex. So you're going to see a structural supply deficit for the foreseeable future. And if we don't get back to the zero interest rate environment, it's going to take a lot of time for, like, you're going to have a lot of you're going to have a much longer duration for the commodity bull market because new supply is not going to come online. And one example that's a very clear example of this is fertilizers. So Nutrien, which is the biggest fertilizer producer, they announced a capex expansion plan when they made a lot of money in 2022. And then all of a sudden they're like, wait a minute, prices have collapsed 66%. So do I really need to spend on expanding production? No, I'm not going to do it. And then they cut back. And then you see this with almost every other producer where for across commodities, they're all just cutting back. You talk to the oil and gas investors, the oil and gas companies, they are like, We have been burning money for 10 years. Finally, we are making money. There is no way we are going to expand production. We are just going to give it all back as share buybacks and dividends. And that's pretty much the sentiment across the space. So the biggest gold mine in Newmont, they want to divest six assets. They want to get leaner and generate more cash flow. It's not a game of expanding your production, expanding your market cap, trying to make it big in the index anymore. It's now a game of I need to be cash flow positive. I need to run a serious business. I need to run a business that's resilient in this environment. And just because the price of whatever I produce is going up doesn't mean I'm going to expand. I'm going to focus on shareholder return. And this is what all the companies are doing, which is why I think this commodity bull market will be a little different. This will be something more like the 2001, 2007 bull run, where you will have demand growing organically because the world is growing, but supply is not going to grow because all these companies have kind of learned their lesson over the last decade. So long story short, that's what I'm seeing is that's my framework in general when it comes to the commodity bull market. This is not a 2009 to 11, oh, the Fed is printing money, so we are going to have a bull run. This is more of a structural long-term bull market in commodities.
No, I agree. It's interesting because there's so many different aspects of it, and, like, if you're a long-term investor, like, certain things in the long-term portfolio that have been there, for years, going back to 2020 is energy. In the long-term portfolio, we've had a lot of energy. My personal portfolio, retirement, like, there's individual names that have been in there for since 2020. And, so people will have conversations with us, and they'll not understand what we're saying. Like, for example, as a trader, like, yes, my trading account, which is my futures account, I'm in and out of positions. Right now, like at the beginning of this year, there's a lot of move in the energy space. We started getting long in the trading portfolio or the futures portfolio. Long term wise, this has been a bull run the whole time in the energy space. So, like you're saying, like these are looking for very long term trades. Like I can see that this is a structural uptrend in a lot of these commodity based sectors. Um, Energy, yeah, it stalled out. It just went sideways. But if you look at the drawdown in 2022, what was the best performing sector during that drawdown in 22? Well, that was continued to be energy. Um, you just look at this stuff over and over again, and you see that we're in a structural uptrend in the commodity cycle. And I think so many people they don't really, um, you go out in the real world and you go, oh, that's so disconnected from the market. Look at technology. Tech is just raging. It's going to go up forever and ever and ever. And as much as we are long tech, we continue to be long it at the moment. I know that at some point that trend is going to change. That technology is going to be the one to be the laggard, and energy and all these reflationary style sectors are going to be the leaders. So, individually, like what are some sectors that people you see are great buys right now, like today, for example?
Great buys today. That's a really hard question to answer because the this entire week almost everything has gone straight up. Whether it's gold producers, whether it's copper producers, anything related to energy, it's all gone straight up. So I think you probably need to wait a bit, but I think if you're just looking at the bigger picture and you don't mind getting in right before the first correction, then gold, copper, oil producers, the oil refineries, and few oil services stocks, not all of them because some of them have issues. That entire space, then fertilizers, then the agriculture space, you have your grain processors, then you have your rates, that is your agriculture rates. So that sector, and I think overall, just across the board on commodities, whatever you buy, it's going to do well.
So the copper miners, that's another interesting one for you to pass your way, which is as we're looking at things like that, the copper miners are something that people are starting to look at. The gold miners are obviously going to be hot on everybody's mind. I think personally, like your thought of, if you're if you're looking for value to add to your portfolio for a very long-term trade, The gold miners are probably very easy to buy here. Yeah, they've went up quite a bit lately, but in the general trend and the idea of something like you or I are really looking for here, this is still very early in that cycle. Yes, they could come back a bit here. Yeah, but once again, is it going to come back? Do I think it's going to come back 20%, 10% even? Probably not. Small corrections on the way up in a structural uptrend is what I continue to see across the board in most of these things. So, what's a couple of the gold mining names or the subsectors that you're really looking at the moment? Because you being the guy, all these years of knowing each other, Kashop has really been the guy who really understands the gold mining sector, unlike most people I've ever met. So, what's some of the subsectors or the individual names that you really like right now?
So I really like Agnico, and the reason for that is so Agnico is now the number two gold miner in terms of market cap. So the first is Newmont, and what's happening with Newmont is they are trying to divest assets, which means they are trying to shrink. And what's happening with Agnico is that they are trying to expand. So you're going to get to this point where Agnico is going to flip Newmont in terms of market cap. And when that happens, the allocations, the passive flows from GDX, the flows from the institutional investors, they'll all flip. So you're going to get more money which is entering the gold mining space is going to enter Agnico than Newmont. And this is something that I haven't seen before. So uh, you have never seen a company which is in the top 10 move all the way up to the top one. And that is what Agnico is trying to achieve right now. And in terms of the story practically sells itself. So Agnico has mines all across Canada, which is the safest gold jurisdiction in the world. They have a mine in Finland. They have a mine in Mexico where they haven't had any issues, unlike Newmont, which has had so many issues with its Mexican mines. And they have a mine in Australia, and there's a rumor they're going to acquire another mine in Australia. So, what this does is it gives them a very stable, low geopolitical risk, long term profile. And that's the kind of thing that someone who's new to the gold space, who wants that comfort, who wants to really understand the business, that's what they would be looking for. And the cash flow story is pretty simple. So Agnico produces gold at 1300 an ounce, sells it at 2300 an ounce, doesn't have any hedges. So the free cash flow is going to be tremendous. And what they're going to do with it, probably send it back in terms of dividends, send it back in terms of buybacks, and that's going to shrink the float. And the thing with these miners is you only need 2 3 quarters of profitability for them to really shrink their float. And once they do, the share price just goes up. So this is a cyclical business, but that is exactly where they can add value by shrinking the float. And Agnico is best positioned to do that. Then you go further down the line, you have I am Gold, which kind of used to be a little problematic producer, but now they have a new mine coming online that's going to gush cash. So then that's one name to look at. Then you have Equinox Gold, which is in a similar situation. So I think let me generalize this. So you had all these miners um, try to build and bring new mines online post COVID, and all of them have been hit with inflation, capex overruns, and lack of personnel, all sorts of issues because of the social distancing and all the other rules. And all of them have suffered one way or the other in terms of trying to bring these mines online. And now, fast forward to 2024, a lot of them are close to completion, but by now, investors have been frustrated. The market has written them off. So, when these new mines do come online, a lot of them are going to be gushing cash, and they have already diluted previous shareholders, and they're not going to do any more growth projects. They have learned their lesson. So all the incremental cash they will generate is going to come back to shareholders in the form of buybacks. So any producer that started building in and around 2019, 2020 and is bringing new mines online now, I think the market hasn't yet caught on to that story, or the market hates that story because of what's the history over the last 4 years. And that's how it is with a cyclical business. You have the extreme in sentiment in one direction and then the extreme in sentiment in the other. And once, if you're able to catch the middle, that's where you make the money. So that's the one subsector I would look at. And the third one is all these quality exploration stocks. So you had stocks that had a market cap of $1 billion in the 2020 bull run, which was very short lived. And now they are worth less than 90% of that. So they are at 5 to 10% of their previous highs. And these are companies, some of these companies at least, they have added value by growing the deposit or growing their project by drilling more holes, discovering more gold, figuring out how to make it more economic to mine it, all these things. And what's happened is just because investors have lost interest in commodities and gold mining stocks, these stocks have been beaten down hard for the last 3.5 years. And now that entire segment of investors who used to support these stocks, that capital is coming back. The private equity is coming back into the space. And the first thing they'll buy is the past winners. It's kind of like what you saw with crypto, right? So you had Bitcoin go up, you had Ethereum go up, and then people remembered all the winners from the last cycle and they started buying those coins. And something similar is happening with the gold exploration stocks. So that's the other subsector I would focus on.
Nice. I think generally, so many people are going to really wonder, what exactly, how do I trade these types of things? Because there's so many people out there who really don't understand things to the extent of you. For example, what there's all these ETFs out there, and you and I have talked about it. There are a lot of them, especially in the gold mining space. They're constructed pretty badly. What's one that you'd look at that you're like, oh, that's okay. That's one of the ones that I think is decent. Not saying it's great, not saying it's something you're gonna buy, just saying what's one that you think is a decent ETF in that space.
The only one I think is decent is the GDX ETF. And that's only because right now what's happened is the market has punished the not so good producers a lot and punished them by taking away their market cap. So even though the GDX is a market cap weighted index,
Mhm.
it's now reflective of the fundamentals of the relative fundamentals of the gold miners. Now, I don't expect this to last because once capital comes back in, the smaller producers just do M&A and try to get bigger, try to get a higher weight in the index. And then that once again distorts the picture because you have all these tier 2, tier 3, tier 4 producers which are gaining share, and the tier 1 producers which are just shrinking their float. So here's the thing with buybacks, right? So these ETFs punish share buybacks, whereas as a shareholder, you want to see buybacks, because if you do a buyback, you shrink the float, which means you shrink the allocation of that stock within the ETF. And it's kind of like you're rewarding the bad companies which increase their float by diluting shareholders, and you punish the good companies which shrink their float. And this is where I think sometimes I think the ETFs and commodities, they offer very perverse incentives to managements,
Mhm.
and they exacerbate the cycles. So only GDX, I wouldn't look at the others. I think you really need to do a due diligence on the space. And there are other reasons for it. So there was a stock, uh, SSR Mining, which used to be an okay stock, just hummed along nicely. And then what happened was they had an issue that they disclosed, and the stock just went down 50% on the news. Now, why is that happening? It's because the people who own that stock didn't do their due diligence.
Mhm.
And why did they not do their due diligence? It's because, well, it has this market cap, it has this relative weight in the index, and you're just buying it along with a bunch of other stocks, and then you have a problem, and then suddenly the liquidity disappears. And the liquidity disappears because the people who actually look at gold mining stocks are never going to touch that stock. So you have these issues which, unless you're into picking the mid caps, you're better off just buying the ETF because you're going to get stuck on issues like this. But if you buy the ETF, then again, you have to understand that the ETF is geared towards the not so good producers, and it's trying to punish the good producers, which shrink their float. So I think this is just a space where you need to actively manage or be okay with underperforming the good stocks. And there's no two ways about it. Like, I mean, you want passive, you get the returns of passive and all the complications involved in passive. You want to do active, you better get it right. There is
Mm.
no in between or a compromise. This isn't like in tech, it's pretty easy, right? Like, you want to pick the Max 7 because you feel those are the most innovative companies in America. You want to pick the Dow 30 because the Dow has a 100-year track record of going up and you kind of trust their methodology. Fine, like you can live with the outcome of that. Like, you do that for 5, 10 years, you'll still be fine because broadly markets go up, and broadly these are relative strength indices, and these are companies that trend. They don't have as much cyclicality as a mining stock. So if you pick indices in that space, sure, you'll be fine. But if you pick indices in these cyclicals, then you have to really know what you're letting yourself in for.
No, I love that because it's really important. I mean, for myself, my own personal portfolio, I will trade individual names, but that's also based on a lot of research. That's based on people like you. And even though I'm primarily a price action trader, I still want to know the things people like you understand because I don't just want to put some names in there because gold miners have a lot of risk. Get into a specific country, you could have a lot of risk. So I completely agree with that fact. Also, like I do like the ETF option, especially like you are a person who doesn't really understand much about the space. You don't want to just jump into it. I've seen so many people get hurt in that market, especially like it's not a market to hold for the next 30 years and think you're going to make money like the Dow or one of these. It could be something like that one day, but at the moment, it doesn't exactly make sense to just have a completely passive strategy where you're either going to own the stocks or the ETFs even for the next 30 years. You have to be tactical about it. You have to be able to trade in and out. If you're in individual names, you have to understand things like you do and trade those individual names. But once again, it commodities to me, whether it's the sectors, whether it's the individual commodities in the futures space, they're all trading vehicles. I think that's incredibly important to understand. As a trading vehicle, you have to know that this doesn't go up forever. You can make some of the best returns you'll ever make in your life in commodities. However, you could also lose everything if you're just holding them for 20 years. Like it's just not a strategy in that space. So, looking at gold and silver too right now, let's just talk about the metals themselves. So if we're looking at the metals, there's been so much movement finally. People like us have been watching this chop fest of gold's almost about to be at all-time highs. Great. Oh, wait, it just came back. Gold's almost at all-time highs again. Oh, it came back again. Gold's sitting around all-time highs for a while. Oh, it came back again. Finally, we're getting that breakout. Finally, we're actually even seeing silver starting to catch up. So, what are you thinking about just gold and silver itself?
I think so. The gold rally, I think it's very justified. So I was just reading this piece by Jim Rickards the other day, and he's the author of The Death of Money and Currency Wars. So two really good books on fiat money. And what he says is the central bank buying of gold is up around 10x in the last 2 decades, which is nuts, which is a huge figure because if you remember the previous 2 decades, they were all trying to get rid of their gold. I think by 1991, sorry, 1999, the Bank of England had completely exhausted its gold reserves, and that was close to the bottom. And gold went up from like $200 an ounce all the way to around 1100 or something in that bull market, and they had dumped their gold at the very bottom. And now what you're seeing is all these central banks are buying gold, and what you're hearing is, sorry, just a sec, just a sec, sorry about that.
No problem. You're good. It didn't show up on the stream.
Okay, yeah, sorry, I had an alert on and it just messed up on the
No worries.
earphones. So yeah. So with gold itself, you're seeing all this buying from central banks. You're seeing buying by the Chinese. You're seeing I mean, Costco selling gold is a game changer, right? Like it makes it so much easier for Americans to access gold. And the Indians have always loved gold. So whenever there's a dip, they are buying, or if it's going up, they are buying because they don't want to buy much higher. And all this gold that's getting taken off the market, especially in the East, and now likely with the Americans as well, like you're buying retail, chances are you're going to hold it for the next 30, 40 years. Indians, we are going to hold it for the next three, four generations. The Chinese, probably the same thing. And this is gold that's permanently off the market. So whatever supply is coming in is going to keep getting absorbed. And that's very bullish for the price. And that's also something that should have happened, let's say, all the way from 2011 when gold topped out, but didn't. So this is a bull market that has been delayed by around 13 years. And why it has been delayed, no one really knows, because if you go back to 2011, 2011, 2012, you would find so many reasons to be bullish on gold. But gold topped out in 2012, and then it had a brutal bear market, even though those were the perfect conditions for people to buy gold.
Mhm.
And there's a theory that Bitcoin stole gold's thunder, and that's why you had this long period of outperformance. And what's interesting is now I remember the time when one Bitcoin was worth more than an ounce of gold. This was sometime around 2016, 17, the early stage of that bull market. And people thought there is no way that's possible. And then gold pretty much went nowhere while Bitcoin had a 40, 50x return from there. And now what's happening is you're seeing this rotation. You're finally seeing this rotation out of Bitcoin and into gold. And that's because they both share very similar characteristics. They both share the same kind of audience, the hard money advocates who are, and some of them are starting to converge right now. So one of the issues people, the crypto community, the Bitcoin community, one of the issues they had with gold was that you can't send gold across the blockchain. Like I want to send uh, something of value to you sitting in the US, I can easily do it with Bitcoin across the blockchain. I can't do that with gold. But now with Tether Gold and Pax Gold, that argument is irrelevant. I can actually send an ounce of gold over to you through the blockchain. And so you taken one argument away for not owning gold. And the other thing is that once inflation comes back, you will find people prefer real assets over virtual assets. And this is what tanked Facebook stock in 2022, where they went all in on the metaverse, thinking people just want to live in a virtual reality kind of world. And it turns out that they actually didn't, that people just want to live in the real world. And when you live in the real world and you work in the real world, you want to own real world assets. I mean, I'm sure you want to own a freezer full of meat and not a pick of a freezer full of meat on some blockchain, right? And that's kind of where it's going to go. And everyone remembers the stories their grandparents told them, where for their birthdays they would get these 1 ounce coins, the American Eagles or the Krugerrands. Krugerrands were popular back then, and a lot of them saved those coins. They got rid of them in the bear market, but they all remember those stories of how those coins went up in value and were the only thing that saved them during the stagflation. So when you see stagflation return, you're going to see, so all those behaviors that we have all these behaviors in our DNA, right? Like from the stories that have been passed on through generations, we all have these instincts, these habits that never go away. Like if you're born, let's say you're born in a poor country and then you move to a rich country like the US, you are still going to hoard all the little things that you hoarded back home, just because that habit never goes away. The habit of thrift that you accumulated because your parents taught you, that's never going to go away. And it's the same with gold. Like everyone knows that gold saved their families during the 70s, during the 60s, and maybe not in the 60s in the US because it was illegal, but in every other part of the world. And when you have all these stories in people's consciousness and you see the gold price going up, and you look outside the window and you see something is not right with the world, what do? You buy more gold. And that's just instinct. And That's that's kind of the instinct. That's the reason why gold has survived as a store of value for 5,000 years. And sure, Bitcoin's getting there, maybe other crypto, other assets, they'll all compete for that role. But once you get that reason as to why people hold physical gold, and once you actually hold your first 100-ounce coin in your hand, I think there's an emotion to it that you will not get with any other asset. Like, is just not possible. You can have $100,000 in your brokerage account, you can have a fancy car, a Rolex watch, anything, but once you just hold a physical bar of gold in your hand, that emotion will just tell you why you need more of it. And I think that emotional aspect of gold, people are going to wake up to it, and it's going to go much higher, just because whatever gold people get onto their hands physically, that's never coming back on the market. Now with silver, it's slightly different. I think silver is starting to run ahead of itself. And I say this because the biggest use of silver is still industrial demand. And sure, industrial activity is picking up, industrial demand is picking up, but will it be enough to sustain higher silver prices? And will investors who are starting to see gold as a store of value go down the line and start to see silver, start to see copper, start to see rhodium as a store of value? I don't know. It could happen, but I would consider that risky. And with gold at $2,300 an ounce, there is no reason to take on that extra risk. I mean, like if you are in futures and you're trading it, sure, but if you're buying and holding it thinking you're going to make this go, you're going to hold this position for the next 10 years, then I think it just makes more sense to hold gold over silver. And also, silver is bulkier, which makes it harder to hold. And then it tarnishes, which again diminishes your value by, let's say, 1% when you try to sell it after 10 years. So
Mhm.
you have all these issues. So, as a trading vehicle, silver is great. But I think if you're just trying to play the structural trend in inflation, gold is your best bet.
No, I like that story. Where you were talking about people, getting gold coins, and I grew up in a family that I did get, like, we didn't have much money, but back then it's kind of interesting to think, like, a silver or piece of silver quarter, that was incredibly cheap. If you get a silver coin or silver coin before 1964, I think it is, in the United States, basically those have silver in it, so you would get those on holidays, or you would get like the silver pennies that were out there back in the day. All of these kind of interesting things that you would get back then. Not to mention silver pennies were a thing during World War II when they needed the copper. So you continued to get these little things, and like it kind of was weird at the time. You're a little kid, and you're like, why exactly? What am I going to use this for? Does this really matter? Will this matter to me in the next 20 years? Um, and yes, the answer was yes. And luckily, I always kept them. I had no idea. It might have just been laziness or luck. Either way, I've always kept them. And I also believe, just like you do, where it's when you have things like gold is easy, it's tangible, it has a monetary aspect to it, which silver doesn't. Yes, silver does. There's going to be so many people who argue with me about that, but I never see the monetary premium built into silver the same way it's built into gold. So that's why I always want to hold more gold than silver. I buy both, but at the same time, I want to own more gold than silver at all costs, all the time. I think that's an incredibly important statement, because too many people, they think about it like, there's these things and they're out there and you could buy some platinum and like all these different things, and really it's like, no, you really want to own gold. Gold is the one, it's the king. You want to own it over everything else. And I do think with you, the same way we're looking at this breakout strategy here. Like finally we see this huge move higher. We've been waiting for it. It was going to happen. Once again, it wasn't something that bothered me about gold, that it just chopped around for a year and a half. That's totally fine. Things that are going down are the things I don't want to own. If we're looking at something like bonds, like, no, I did not want to own bonds. That doesn't make sense to me. But I absolutely want to own gold. Gold is just sitting there flat. Even in the nasty bear market that it had, it wasn't the worst thing ever. It wasn't great, and it was a great buying opportunity for people who start to buy gold at certain points in their life. And that's why I think, corrections are very healthy. bear markets are very healthy. It gives us a chance to buy things. It's why, our parents always talk about how they got, you know, basically they could just buy the market and sit back and, do things for the rest of their, let's hold on to it for the rest of their life, and they were fine. Yes, because most of them were building wealth around late 70s, early 80s. Yes, you had this crazy bull market for the next 20 years. And basically, you were taught that if you just hold your money, it'll always come back. And it has. And then they've continued to be right in that fact. Sure, that's all good and fine. But once again, there's many different ways to look at markets. And two, they would have diversified in a better way than just owning stocks and bonds. They wouldn't be in the situation they are in today. They're all retiring and they need their money, and the bonds have absolutely decimated some of their portfolios. So I think it's incredibly important to have something like gold in your portfolio. And you find through back testing that even if you're looking at something like if you have 10% or 5% of gold in your portfolio, you will end up in a much better spot than you would if you just have no gold in your portfolio. So, meaning, like however you want to do it. You want to buy a GLD ETF and put it in your portfolio. I'm not against that, but I think the physical idea of gold is great. And also to talk about the Bitcoin thing, that's incredibly interesting because so many people say that, once again, I'm a proponent of both. I own both. I've had both. You and I have been in the Bitcoin game longer than most of these kids who talk about it and argue with us have been alive. Um, it's kind of true at this point. Like some I got an argument with a 14-year-old the other day, and I didn't even realize they were 14 for a while. It's like you and I have really been in this game, tried to understand Bitcoin in a very deep way. We've been in this for over 10 years. Like and trying to grasp this fact that people go, well, I just own Bitcoin, you'll be fine, don't buy gold. I think it's important to have both. Gold is that stabilizer in your portfolio. It's the very boring thing. It's not going to make you rich, but it's the thing that can stabilize your portfolio, continue to add wealth to your portfolio over time. And yes, when you're young and you first start trading or you first start investing, that might not matter to you as much. But if you've built up your wealth over time and you're into that 6-7 figure zone, like that's really going to start to matter to you, because the last thing you want to do is have something that's you're at, let's say you hit 1 million, and let's say you have, your entire portfolio is in Bitcoin, and let's say it has an 80% drawdown to 200,000. That's not going to be very fun. But if you had something like gold in your portfolio, and let's say that's 800,000 of your million, and then you have 200,000 in Bitcoin, you get all the alpha of owning Bitcoin at the same time of having this stabilizer in your portfolio. Once again, that's just an example. That's nothing I would ever suggest somebody put, 80% gold and 20% Bitcoin. It's just an idea, way of thinking about it. But really, it's like, for me, long-term holdings, I only want, a few percent in something like Bitcoin. It's a very volatile asset, something that I'm holding, not saying trading. Trading's different. This is just holding long-term for long-term wealth. And then something like 10%, 20% of gold, that makes sense. And then the rest of it can be your retirement account, whatever that is. And granted, like that's going to change over time with the market fluctuations and so on. Obviously, the Bitcoin position for people like us have gone up a lot because of holding it for so long. It has just gone up in value over time. And trust me, there's plenty of times over the years you're going to be like, damn, I wish I put everything I had into Bitcoin. Like there's going to be times in our lives where we all think that. I've thought it, you've thought it, everybody has thought that at certain points in their life. However, when you're in those drawdown periods, which they happen a lot, like that's a very normal state for a market to be in a drawdown. When you're in those drawdown periods, you're going to be like, thank God I did this like this. Thank God I had myself diversified. It's the reason why you don't see like huge investors, the ones that really made it, you don't see them continuing to have all of their money just in the markets, like they're just in their trading account. They diversify into real estate, they diversify into different types of investment, different businesses, and so on. This is incredibly important. And I think it's something that people don't practice at the lower end. Even if you have just a little bit of money, if you practice that diversification, you will hold on to it a lot better than just saying, "Hey, I'm going to chuck it all at blank and hope it goes up to $100,000." Like that's just gambling. And also, when you get to that big zone of 100,000, let's say, like you're not going to want to ever give that up. You're going to go, "Oh, well, this is going to be great forever." And then when it draws down back to your initial investment, then you're going to be mad, you're going to be upset. So you might as well figure out a way to diversify, figure out a way to come up with a style of trading or a style of investment that makes sense for yourself. And when you have major profits or you're making profits from someplace else, you can put it into all these different areas. Commercial real estate is a great one. Understanding taxes and how you're going to do those things. I know this all sounds incredibly boring, but it's really, really important if you want to generate long-term wealth.
So this the Bitcoiners like to say that if you bought Bitcoin at X and you held on for 10 years or 5 years or whatever, you made this much. And that's the same argument you can use for any other asset. But what you just talked about, the holding on part, no one talks about what it takes to hold on to something for that long. And uh, let's say you're leveraged, you're in futures, and your margin 5 to 1 or something, then there is no way you can hold on. Now, let's say even you're levered 150%, there is no way you can hold on. Now, let's just say you've taken all the equity you have in your account, your entire net worth, no debt, and you put all of that into one particular asset or one particular strategy and you have a drawdown. Maybe you can hold on. But let's say you take that down a bit. Let's say you put 50% of your net worth in Bitcoin or Nvidia or Apple or any of these other assets, right? Now you have a drawdown. You're able to hold on slightly better than the guy who has 100% of his net worth in it. Let's say you just have a 5% allocation to it and it goes down 80%, which Bitcoin always does. Now you can think maybe I should add some more because you have 5% in it. There's a long term strategy. Now is the time to really add. And by the time the asset has an 80% drawdown, that's 5% become 1% of your portfolio. So you have room to grow it. And this is where the compounding happens. So when you say if you had bought this and you held on, that only works if you have a smaller position size, not when you just buy the asset with your entire net worth or you go irresponsibly long. There are influencers on Twitter who talk about this, that they are 80% of their portfolios in Solana, 20% is in Ethereum. Or then you have the Bitcoin maxis who say sell your house and buy Bitcoin, max out your credit cards and buy Bitcoin. There was a guy who actually maxed out his credit cards and bought Bitcoin, and he's fighting with me over my lack of bullishness on MicroStrategy. And you have all these behaviors. What happens in the first drawdown? Well, they add, then they compound the error, and then it's the slow path to zero. And all this happens because people think you need to take crazy position sizes to make crazy returns, and that's really not true. If you zoom out and have a longer term perspective, and I'm not talking about the trading part, I'm just talking about the buy and hold part. You're better off holding a smaller percentage of your capital in something and adding during those drawdowns, or just having a strategy to hold it for the long term, than to just say that you're going to hold through all the drawdowns because you really believe in it. Because if you're going on just conviction and you have so much at stake, that conviction is going to get tested, and this buy and hold part is not going to work. The buy part will work, and after that it's all going to go downhill. The emotions just get too much into play, and this is exactly why we see bear market bottoms. People at that point just get frustrated and give up, and then the asset goes nowhere for a while, and then a new cycle resumes with new buyers, new sentiment. And why? Mainly because people who are over leveraged or too much into it in the last cycle get washed out. And so I think that's incredibly important when you talk about holding. What really goes into holding? It goes into sizing your position properly. It's not just listening to some influencer and putting 100% on something, or even 50% on something, or taking credit card debt to buy Bitcoin. Like all these strategies, That's not a guaranteed way of long term success. And almost no one who is successful has done it that way.
No, that's incredibly right. And once again, it's you people think, especially like as a trend trader, for me, people think like, oh, well, why would I do what you do? I could easily just have bought Bitcoin 20 years ago. And it's like, well, number one, like as a money manager, the first thing I do is try to figure out yearly returns. Like, how do I give my clients yearly returns over and over again that are good? And that's the most important thing. People don't care that, like, hey, if I went to my clients and I said, hey, we're in a 50% drawdown, but don't worry, it's going to come back. Like, once again, I mean, Kathy Wood does it. I guess that works for her, but that doesn't work for me. If as a trader, like, that doesn't work. There's no client that would stick with me. Once again, you're going to go through rough periods as a trader. And if you set up your clients right to do that, you absolutely can get through those periods and it won't be the end of the world. But at the same time, you're not going to be able to really compound and generate wealth in a great way with having drawdowns like that. Now, once again, it's going to be okay, I'm in Bitcoin, and unless you have complete conviction, like I'm never even going to look at this thing, like I don't even want to see what my portfolio is. I'm not going to look at it for 40 years. And not to mention, you have a huge risk then. And that risk is what we all know and everybody fears is, what if one day somebody said, hey, Bitcoin is now illegal? What if these things could happen? That's a huge risk that you're having by just holding on to that for the rest of your life. But once again, if you did it in a different way, if you said, hey, it's 2012, I'm going to buy this thing called Bitcoin. I have no idea, but let's say you have $100,000. You're going to put 2% of your money into it. You're going to put 2,000 in it. You're going to look away from it for the next 10 years. That's a possibility, but once again, why even do it that way? Like, it doesn't make much sense. So still, it's like, if you need to do it that way, that's a way to do it. But once again, you could do it many other ways. You could trade it. You could look at it like a trading vehicle. For me, it's like a commodity. I'm never going to buy oil and just hold on to it for the next 40 years. But I will. And once again, oil has a lot of value in the world. Because something has value doesn't mean that it's going to be worth a lot of money forever and ever and ever. So you have to understand that first off. And because I think Bitcoin is very cool, and like you said, you can use it for transactions, you can use it for all of these things, it doesn't mean I think it's going to be perfect forever and it's going to go up in a straight line. Once again, these bear markets can be very nasty. New technology can also, and Dave said, play the cycles. Yeah, absolutely. And Dave said play the cycles, and that actually brought me into another thought, which is, when you are in those and you understand things like Bitcoin, and you go, okay, Bitcoin is very cyclical. These are you fundamentally, you can find periods of time where it is very bullish to own Bitcoin. But technically, you can ride those trends, and you could have made a lot of money riding those trends up and down. So I don't understand the exact reasoning and just saying, hey, like, I believe in this, like anything. If it was Apple, if somebody told me, hey, I believe in Apple, I think it's the best company ever, it's going to go up forever and ever and ever, I'd still say, why would you want to do that? I think there's a better way of doing that. I think trading is a much better way of handling that. So you don't have to handle the drawdowns. But once again, if we're just talking about putting some money away in a portfolio, like you said, having very small position sizes, buying something like Bitcoin, at a very small position size, being able to hold on to it because you're not going to be too in fear of those drawdowns. But what everybody does, and like you said, and there's so many influencers out there and gurus out there talking about things like, I am irresponsibly long. Cool, good for you. But if 99% of people did that, they also don't know what irresponsibly long means. Irresponsibly long to somebody that could mean 1% of their entire portfolio. To a kid who has, a couple $1,000s that he's trying to invest, or, the retired person who's got his retirement portfolio and he's thinking about maybe putting the whole thing into something like Bitcoin, that's way worse. That's way more irresponsibly long. That's everything you have into an asset that could go down. And once again, nobody likes to talk about that when it comes to Bitcoin, but it's like I wouldn't having a conversation about oil. Like I am long Bitcoin. I'm having a conversation about it going down. That's very normal. That's what we do as traders. Like I've had so many people come up to me and talk to me lately about the fact that they don't like how bearish I talk sometimes. And I'm like, well, I'm long all these things. I'm very long the market right now. But as a trader, I have to always be understanding what's the risk. What type of risk do I have right now? How much money could I lose today? How much money could I lose this year? What am I willing to lose? You know, these are questions you have to ask yourself. And I think people who go, I'm just going to buy X and be fine, like they don't think about that. Because once again, the biggest thing about this game is the drawdowns. A 50% drawdown, you need to make 100% to get back to even. So what if you just cap your drawdowns and figure out a way to hold your volatility to 10, 20% normally? You know, obviously you can have outlier years where you go down even more than that, but let's say you try to stick to that. That way you don't have to make much to get back to even, and you can get back up to all-time highs pretty quickly. So that's just a way to do it, and that can be done through diversification. That can be done through models like trend following. That could be done through fundamental models. However you want to do it, but that's incredibly important. Risk management is everything, and it even comes to buying things that you're going to hold for the next 20 years.
So the last cycle, right when the lockdowns happened and the Fed started printing $3 trillion or so, there was this guy, Dave Portnoy, Barstool Sports. He had sold his company and he had nothing else to do other than review pizza joints. So what he did was he started talking about stocks and he started buying stocks publicly and he watched them go up and he said, "This is so easy. Why is Warren Buffett not doing this? Why is his performance so terrible compared to mine?" And he did that for a good 2 3 months. He got popular, and then the economy opened up, and he went back to doing whatever he wanted to do. And that's the thing with these irresponsibly long stories or all these crypto uh, 0x to 100x stories. And that is all they are. These are guys who come, get onto the spotlight for a few months or a very brief period, and then they just disappear. And the reason they come onto the spotlight is the same reason they disappear. The reason they come onto the spotlight is because they got lucky doing something, being in the right place at the right time. And when their luck runs out, they are out. They are not going to compound at 30% a year for decades. They are probably not even going to compound at 0% a year for decades because they're going to have that one moonshot. And if they are fortunate, they're going to sock a lot of that money away. And this is actually why Mark Cuban is my favorite tech investor. He saw the bubble, he got out right at the top, and he got completely out of tech and he got completely out of the market. And that's really the story that people should be looking at, not the stories of these influencers who are irresponsibly long and who just ride the cycles. Because you need to be the guy who sees it and who gets out of the game when you're done. Like the big shot guys, they saw the trade and they didn't hold all the way until the point where they could have squeezed the banks. They all sold at a good profit and they got out. And this is a fund manager, Andrew Lade. I'm not sure if I'm saying the name right. His fund closure letter is a great read where he says, "I am done with this life. I had a miserable 2 years, but I made a lot of money, and that's enough for me to retire. And that's it. I'm done." And that's really the, I mean, if you're one of those traders who has that huge 0 to 100x move, right? Like, I think that really puts things in perspective. You don't need to, so what you have is an accident of history. You're in the right place at the right time. You made a lot of money really quickly. That's not going to repeat. So unless you can figure out how to consistently generate a good yearly return, you're better off just getting out of the game, getting into T-bills, doing something else with your life. And people like us, we are traders. We love the game. And we are never going to be those guys because we are never going to take the kind of risk that goes from 0 to 100 in a span of a few months. We are going to be steady compounders. And there's room in the market for both types of people. But I think people, if they want to be traders, then they shouldn't compare themselves to the crypto guys who just come buy some meme coin on Solana or some NFT, make a few million, and then flame out. Like, it's really not a right comparison, I would say, because it's just two different worlds, two completely different sets of mentalities involved. And if you're watching this, you're a trader, and you should be focused on trading, focused on your process, focused on how do you compound for the next 10 years, for the next 20 years, and not how do I make the most amount of money within the next month or two. Because those two strategies, the answers that these two questions have, they're going to be very, very different.
No, that's so well said. I like the part of it where you talked about, do not compare yourself. That's incredibly important. I mean, I'm a trader who's put together 100% years for people, and people will still come up to me and be like, "Hey, my little nephew did this. He bought this meme coin and did this," and it's like, well, once again, like the amount of money that you're managing is one thing. Like somebody's little nephew, if you give them $100, yeah, they could make 1,000% on something. That sounds great. If when you're managing 7 8 figures, like that's a very different game you're playing. And that game is to preserve wealth. And when you can preserve wealth and generate returns, because at the end of the day, that's really my job, isn't to make all the money in the world. My job is to protect my clients' money above all else. That's the goal. Like if I can just have low small drawdowns and even small periods and then some great years, that's my job. It's not doing the crazy thing and taking all their money and putting it into something that I think could go up and triple their money in 2 days. That's incredibly irresponsible. It can also lose all of their money in 2 days. So that's not something that you do as a trader. As a trader, you're protecting your capital. You understand that like this is a long game, and being a long game, if I can generate some great years. So for me, like what I really try to do as a trader is I'm looking for to get to at the beginning of the year. I usually try to just grind up to 20%, meaning I'm going to not have huge positions. I'm going to not add to my positions. I'm not pyramiding into anything. Once I get to this 20% level, then I'm going to be a little bit more aggressive. Then I'm going to start taking a little bit bigger position sizes, possibly some more leverage, maybe even some options trades. Like that's when I start to do things like that. Because really, the game is if I'm compounding. I mean, think about it, guys. Like use a like too many people who trade do not do this one simple thing, and it's so easy to do, and I'm always so surprised people don't do this, which is go find a compound calculator, or just the math is pretty simple, but anyways, use a compound calculator. Google online compound interest calculator, pump in $100,000, put in 20% over 20 years, see what that comes out to. Understand that if you're just doing 20% year after year, that's an incredible amount of money. It's the same reason why people go, "Oh my god, I can't believe I do better than Warren Buffett." Like Warren Buffett's compounding with billions and billions of dollars at 10 20%. It's insane. Pump that into the compound calculator, see what comes out when you look at that. These All of these things are incredibly important, because you have to understand that like your expectation doesn't need to be to make all the money in the world so you can retire tomorrow. It is a long game. So if I'm making 20% a year, and then some of the years, like I said, now this year is a good example. This year we're way above 20% already. That's great. Now what do I do? Now I can start to add leverage. Now I can start to get to those numbers that are 50, 60, even 100%. I mean, myself, I'm one of the few people I don't usually toot my own horn here too much, but I'm one of the few people who's compounding at almost 100% a year. And this is the reason. This is the way the math works. Now, once again, it's not a game of, hey, I'm compounding at this because I'm just going to hold these crazy things and I'll look at this meme coin and this penny stock. Like that's not the game. The game is consistently trying to take the right trades over and over again. I like the Alexander Elder quote, and I'm sure you've heard it as well, which is our job as traders isn't to make money, it's to take the right trade. And like That's what I think about every single day. Like, I get up, I take the right trade. If there is no trades, like, we in our portfolio, like, I keep telling I told people the other day, I'm like, "We've made a ton of money, but I'm sorry, it's boring. We haven't done had to do anything." And that's the truth. Like, we just have been positioned the same exact way all year long. The only new position is in the portfolio that I haven't really even updated completely yet is things like gold miners, but gold and silver is already in there. We're basically sitting in all of these positions that are doing really well, and that's really the thing I love about trading. And I like the one thing I heard recently. It was in, I think, Covell maybe posted it in a trend following thing, and it was a quote from, I think it was Jesse Limbernoir's nemesis, and the quote was kind of interesting, which said, I didn't make my money by taking new trades. I made my money by holding onto my profits in my good trades." And like, it's true. So, but there's two parts of this. It's important to be able to hold on and be able to hang on to those really good trades to make money. Think of something like cocoa that makes our whole year. Great. Hold on to that. Awesome. But then the other and the more important part in back testing, you learn this, it's the exit. The exit has to be the most important thing that you work on as a trader. Um, there's Tom Basso had a great one years ago where he did a coin flipping strategy. Coin flipping strategy basically means you can use a random uh, generator to basically say buy or sell. You just buy and sell things based on this, and you use good position sizing, good entries, good exits. And he found out that this outperforms the market still. How crazy is that? So really what it tells you is that the entry isn't the most important thing in trading. It's the exit. So you have to be understand how to exit, you have to understand how to hold on to these major trends, but most importantly, how do you not lose money? That's the game. And it's the hardest part of it is figuring out, like, okay, cool. I've had, like, you got everybody who's watching, they wait for picks. They want to hear picks. And I'm not trying to hate, but I'm just saying this is what people do. They're looking for picks all the time. They want, if you made a letter or I made a letter and it was just, hey, look at all these things we're buying today, and I did this over and over and over again, people would love it. Buy signal services. People love signal services. All this crazy stuff. But at the same time, like, none of that makes money. What makes money is like the person who's going to tell you, "Hey, it's time to get out." hey, I have an exit signal, which nobody wants to hear that. So once again, it's the hardest thing about writing and talking about markets is like to do a good job and actually absolutely help people to make money. You have to tell them hard truths, which is, hey, Bitcoin, it might go down at some point. Hey, have an like the video we put out, have an exit strategy. Like, these things are incredibly important, but as long as you're in the phase of going, hey, I want to figure out what to buy. Hey, I want new trade ideas. I had somebody write me a pretty nasty email the other week, which was about I didn't put out enough trade ideas, and he wanted more trade ideas and levels to buy and blah blah blah. And I was just like, look, dude, we've been in these positions for a while. I know it's boring sometimes, but that's trading. Like, I'm not a person who's ever going to bullshit you guys and tell you guys to buy and sell things like all the time just to like keep my numbers up. I'm just going to tell you sometimes, hey, there's nothing to do here. Hey, we're making money. We're just riding trends. Let's go to sleep. Like, kind of the game. So I think the thing you said about, understanding those things, and then the thing I'm saying about exits, like, these are all the most important things that I hope people grasp from today.
Yeah, so I think broadly, if you focus more on your allocation, more on your portfolio construction, more on where is your maximum drawdown on each trade, and by extension on your whole portfolio, you focus on these things. Even if you use a random entry strategy, you will still be fine. And this is something, I mean, so I'm a discretionary trader, so I haven't back tested it, but from my experience, I found that random entries work totally fine. So when I'm adding to a position, or when I know it's kind of getting close to an exit, and I have a random exit of say 5% of my position on this
Mhm.
day, not something I think through, or not a price, nothing, just completely random. And I do it that way. In the long run, One, it frees up my mind for other things, and two, it doesn't really matter.
Mm-hmm.
Like, sure, like you need to have a perfect entry and a perfect exit, and by doing that, as a trend follower, as a systematic trader, that works for you. But if you focus more as a discretionary trader, you focus more on the portfolio construction and the allocation, you don't really need to give too much priority on where you buy and where you sell. It's not that it's not important, it's just that the other things are more important. And these are the things no one talks about because, well, no one cares, it doesn't sell newsletters. But
Yep.
actually, this matters more than the exact entry and your exact exit.
Mm-hmm.
This is what I found from my experience, and I've been doing this for, I've been trading full time for close to 3 years now. So this is my experience. I know you may have a different take on it because you have a different approach, and of course you've been in the markets longer. So what do you think? Like, am I on the right track? Yeah.
No, I think what you said is actually spot on. I don't think number one, so if I'm looking at my very long-term portfolio, my retirement portfolio, the one that I don't really post, it's what I do personally. I'm mainly looking for the allocations at that point. So how much am I willing to allocate to energy? How much am I willing to allocate to this stock? How much am I willing to allocate to this sector? Like that's what I'm really looking for on that type of a portfolio. Even the long-term ETF portfolio, there's times where that's what I'm doing. So positions will be lightening up, positions will get heavier. Like that's what you have to do kind of in a very long-term investing way. When you're looking at just entries and exits, it's not that it has to be a perfect entry and exit. That's very far off of what I was trying to say. What I'm trying to say is that when you're a trader, you have to have an exit, you have to have an entry. Those things are more important. It doesn't mean like I've never found that selling into strength is the best course of action, but that doesn't mean that that can't work for people. Like so it's really like trading such a personal thing that you just have to kind of figure out what's your style, what's your strategy, how do you hang on to a trend, what is a trend to you. It could be completely different for everybody. I was talking to that interview I did recently, Mr. Breakouts, Tomas. Great interview, loved it to death. I have no idea how his strategy works. He mentioned that he does a 1 week trend following breakout strategy. I have no idea how that works. His returns are good. So what does it matter that I don't understand how it works, like so it's really figuring out what works for you, figuring out that you're basically looking at your strategy and going, okay, well, I don't I lighten up positions here, it doesn't really matter, and frees up my mind. That's also like incredibly important. Like once again, like it's I think too many people, like when you have too big of positions, for example, like let's say you're just like feeling bad about a position and like it's going up and you're like, I'm too big in this position, I can't handle it. Now once again, if I back test this, it tells me that no, I should never sell that position to feel any better about myself. However, forward testing and living through things, I know that it's incredibly important to be able to lighten up positions and free up your mind. I know that it's incredibly important for me to sometimes, and this is completely what you shouldn't do as a systematic trader, is take off all positions at times. I have had to take breaks because mentally I am not in a place where I can trade. That is the opposite of what you should do as a systematic trader if you just look at the back test. However, every single time I've come back and traded after that, I've done really well. So once again, it's a like there's the what I should do, and then there's the what is real. And what is real is if my mental health isn't okay, I'm going to be a shitty trader. That's the truth. And I've done it before. I'm not a good trader when my mental health isn't okay. So I have to figure out how to do that above all costs. Even writing, like the other day I have an emergency. I shouldn't be writing in that state I was in the other day. Like my dog passed away. I had a really crazy thing. I'm adopted, so I found some family. Like, it was really wild day. I shouldn't be writing in that type of position, so I didn't. I shouldn't be taking even my signals sometimes during that type of thing. So I might not do that. So once again, once again, it's the boring topics, right? It's the things like you and I will talk about all the time that are the most important things and the real secrets to making money. It's that Mr. Breakout's interview is probably one of my favorites because, like, we just dive into that stuff completely. We barely talk about trading in it. But once again, I think that there's incredible importance in lighting up positions to feel better about it. I am not a vol targeting trader at all, but like, and I'm not. Jerry Parker is one who will argue it to death. Hey, I don't I don't like vol targeting. It's stupid. It's bad. And he'll argue it to death. And I don't vol target, but once again, I think it's incredibly important for people who do it to just understand that that's their personality. They need to do that, and they probably couldn't trade the way I do. And I don't want people to trade the way I do. That doesn't make any sense. I have a very different personality. I am very good at going against the trend. Um, and obviously, not meaning trend following trading, but just in life. I'm good at staying with things when everybody's telling me I'm an idiot. I'm very good at staying in a full position as it's like becoming dominant in my portfolio and just going, well, that's the way it goes sometimes. I'm not affected by volatility like other people. So I know that strategy fits me. But if I was different, if I was a trend following trader and the volatility did affect me, I would certainly say, like, because that's what I tell people. I had a person I was actually helping them put together a strategy and helping them back test and everything. And I asked them all these questions about themselves. And I said, they're a professional trader, and I'm sitting there helping them create their system. And I go, so, tell me a little bit about yourself. What'd you do as a kid? What'd you do with this? And they're like looking at me like I'm fucking insane. And I'm like, just keep answering the questions. So we finally get to the end of it, and I go, okay, well, we need to vol target these positions. We need to trim your positions on the way up. You shouldn't be pyramiding. And he was like, what? Why wouldn't I be pyramiding? That's what I always do. And blah, blah, blah. And he's going on this tangent with me. And I'm like, well, it's because of your personality. You're not going to handle it. You probably don't handle it well. And he agreed. He's like, I don't handle it well. You're right. So I think it's understanding your own personality, or talking to somebody who's a trader who might understand that your personality doesn't fit those things, and then figuring out how do you do it. Because I mean, you and I know it. We've met so many people, and you've seen, like, when we first met, like, my strategy of just trend following and buying breakouts probably sounded crazy to you. And once again, it's like we've talked about my friend who had worked at the prop firm who traded off moon patterns. Like, there's all of these crazy things in the market and people who have figured out to make money in it. I think it's just like the more important thing, the question we don't talk, and the things we don't talk about enough, is how does it pertain to you? How does it fit into your strategy and your system? How can you be the best trader that you need to be by understanding these things about yourself?
So, Jason, before we end off here, so I have a question for you.
Mhm.
Where do you stand on benchmarking? Putting out a monthly performance versus, say, the SPX or the Qs now, because no one cares about the SPX, right? It's like so old. It's all about outperforming the Qs or outperforming NVIDIA. So, where do you stand on that?
Ooh, that's a great question. So, Um, I don't benchmark myself. However, like, for the fund, like, I have to put out a benchmark. That's the thing people like, they want to see. Um, the thing that I see that's kind of funny though is every fund curve fits it to themselves. Like, if I want to look great, I will just benchmark myself to a CTA trend following thing, and like, I'll look great. And so a lot of the funds do things like that, where they, I forget what's the name of the index is, but they'll basically benchmark themselves to a hedge fund index. Hedge fund indexes, like, there's so many good and bad funds out there that basically the bad funds really outweigh the good funds, and that the performance is always crap. So they'll just benchmark themselves. Look how great I'm doing compared to the other funds. And then if we get to the world index or the S&P 500 or the Dow even, I think that it's important to outperform it, because you want to know that as a trader, you're not wasting your time, money, and energy just doing this all the time. Like this is way too much work to have something like that outperform you. You might as well just put your money in that and have a much funner life. Um, but and the next thing to kind of look at is, okay, but do I look at it monthly or weekly even and go, oh, I'm not performing the S&P? No, hell no. Quarterly even, no, hell no. I think that's ridiculous. I think that's stupid. You're gonna just drive yourself crazy, because once again, like, what's your strategy? Well, if your strategy is, like, let's just talk about my long-term ETF portfolio. This is a no leverage. So I have two different portfolios: an ETF portfolio and a futures portfolio. The futures portfolio is where I trade. There's leverage. The ETF portfolio, there is no leverage. So looking at the ETF portfolio, and I go, okay, well, I've underperformed at the beginning of the year. I underperformed the S&P for like the first 4 days. If I was looking into that and reading into that, I'd be like, oh my god. And I've watched fund managers do this over the years like crazy, and they drive themselves nuts. And they're like, oh my god, we're not, if we put out our monthly statement or a quarterly statement and we're not outperforming the S&P, we are worthless. Like, and they set their self-worth completely in this. And then now people are going, okay, well, it's got to be the Qs. Well, the Nasdaq's going to have plenty of worse years than the S&P. This does happen too. So once again, it's like people will just shift that to whatever they feel best at. Oh, the Qs are doing the best last year, so therefore I didn't beat the Qs, so you're a terrible trader. And then like the next year it'll be like, well, the S&P is the best, and then small caps, oh, you didn't beat small caps. Like, people are going to just jump around forever. I think the best thing, and the only reason why I use it, is because I use it to see relative strength anyways, which is the S&P 500. I think the S&P 500 is the easiest one to use. The problem is right now it's so tech heavy that it's really, really difficult to understand like where the returns are really coming from. Last year, all the returns were just from tech. There wasn't anything else that was driving up the S&P 500. So I think that it's so easy to get stuck in the I'm not doing well enough, I'm not good enough, because that's like a normal human feeling. I think we all kind of feel that way all the time. And so if we're not feeling good enough, and then we see this S&P 500 thing that's outperforming us, and then we see like on Twitter these people who, like, they're not even really trading, but they continue to just make posts all the time about like things they're doing. Hey, like, look at this one trade. Like, not saying they're not trading, sorry. They are trading, but they're not showing you their portfolio. They're showing you one trade. If I showed you one trade, for example, if I just pulled out and screenshotted my cocoa trade, for example, and it was like, look how much money I've made in cocoa, people would think I was the greatest trader of all time. But really, it's like, it's one position in an entire portfolio. How you do on a yearly basis, like, that's the only thing I want to see. If you want to send me a quarterly statement or a yearly statement, great. So I think it's like you have too many of these things out there where people already feel bad about themselves. They hear about somebody's great trade that they missed out on and they feel stupid. And then the next thing is that they go see the benchmark, and the benchmark is so tech heavy last year that everybody felt like they did a terrible job if they didn't outperform the S&P 500. It's like it's hilarious to kind of think about, because you're like, well, your self-worth is based on an index that is tech, completely tech. And also, this is for people who are commodities traders. This is for people that are energy based funds, like gold mining funds. Like, they're comparing themselves to the S&P 500. No shit, it's going to kill you some years.
Yeah, and so the reason I asked this is there's this firm GMO. They
Mm-hmm.
put out their quarterly report in the beginning of March, where they basically said Apple is 7% of the S&P, and if we don't own Apple, it means we are taking a call to deviate from the index by 7%. And when you have a situation where these companies which dominate the index outperform everything else, just not owning something itself is a bold call. And they were trying to say that we as a firm are making these bold calls and hope you forgive us. That's the reason, that's basically the message. But it got me thinking, because there are people like including me, so I own around 70 stocks. I would never put 7% of my portfolio in a single stock. And because I understand mining, I know how disastrous that can be. Maybe I'll have a position grow to 7% over time, sure. Maybe at times I may have 7% in a stock, but I would never concentrate my portfolio in a way that someone would concentrate on the S&P 500. And how do you benchmark yourself to the index, which is so concentrated, when you're running a strategy that is so diversified? It's the extreme opposite. And it just got me thinking. And every fund manager, everyone who's on FinTwit, they all talk about this problem. It's becoming a big problem these days. And I don't think it was this big a deal earlier, was it? It's just a recent phenomenon, especially when you see Nvidia goes up 2% every day, it's up 80% for the year. And if you don't own it, then what is wrong with you? You don't have the benchmark weight in it, there's something wrong with your fund. And is this kind of very short term thinking that's come into picture, mainly because everyone is focused on the benchmark. No one's really looking at your absolute return or your long term performance. Everyone wants to know whether you beat the benchmark. Like you said, weekly, that's even crazier, but everyone wants to see you beat the benchmark on a monthly basis. And it's just insane. Like, I really agree with what you said. I think all fund managers are driving themselves nuts by doing that. And this is something that, if you're an independent trader and you don't have those constraints, I think this is where you can really outperform. Like, just ignore the index, do what you do, and chances are, on the long term, you will end up outperforming, just because everyone's so focused on fighting in that narrow pond, right? It's like you have these. You go to these places where you have a lake, and you can get this popcorn or seeds or something, and you throw it into the water, and all these fish just come in and fight for the same piece of popcorn. And then you have this other place where the fish are just tranquil and swimming along, and it's like everyone's fighting over here, and these are the guys that don't care. And I think if you're in that scenario, I think you really can outperform only if you just ignore what's happening on this side of the pond, right? So that's something I've been thinking about.
No, that makes a lot of sense, because I just think it's a thing we continue to see in the market, which is whatever the last thing that happened, everybody's going to continue to be in that. And I think it's also important, like, if you're a fund, what did your clients pay you for? Do they pay me to be a tech investor? No. Do they pay me to buy individual stocks? No. Like, that's, so if you're a fund and you're like, hey, I got to buy Apple, because if we don't buy Apple, like, my people are going to be mad at me. Like, why did they invest with you then? Why did they invest? They could have just bought Apple themselves. Why in the world? Like, and it's also the thing of, like, as a fund manager, and this is the hardest thing, to have your own conviction. Like, your own conviction and your own strategy, and not changing things. When I first started, it was very easy for someone to come in and be like, hey, your system is struggling right now. Like, for an investor, like, who watches you and you're killing it all the time, and you have like a month of underperformance, in their head you're like, maybe they need to switch something. Like, they don't understand trading. So you have to explain to them, hey, like, this is my strategy, this is what we do, this is how I make money. And if you don't understand that, I don't know what to tell you. That's an incredibly important thing to tell your investors, because if you're sitting there changing your strategy around into things you don't understand, you're going to lose money. And trust me, like, there's times that you go on and you're like, man, if I could just buy Apple, if I would have bought Apple last year, I wouldn't get all these phone calls from my investors being mad that we're like, an energy fund per se last year. They probably had massive underperformance last year compared to the tech investors. Sure. But did your investors come to you to get the diversification that they couldn't get by just buying the S&P 500? That's something you have to ask yourself. And so once again, it's a yes, like my thing is people come to me for a trend strategy, they come to me for futures, they come to me to trade all of these different markets and get the diversification that's much different than them just buying the S&P 500. So I will always do my strategy and just try to do that to the best of my ability. Does it matter if I underperform the S&P? No, absolutely not. Is it something that I would pay attention to just to kind of be like, okay, let's make sure we, over a year or two period of time, we continue to massively outperform it? Yes, I will do that for that reason. But I think it's, from the fund manager perspective, I understand the feeling of just wanting to be like, oh, damn, if I'll put some money here, maybe my investors will shut up and they'll be happy. But once again, like that means you're investing in things you don't know much about. You're doing it for bad reasons. And honestly, like once again, like if that's happened for a full year, most of the time that might not be the biggest outperformer the next year. You don't know. It could be, those things do happen, but sometimes they don't. And so you could be buying the top in one of these things, and then what are you doing? Are you just doing it to then tell your investors, hey, look what I did for you. I bought Apple. Don't leave. I bought Apple for you guys. Like, is that what you is that the plan? Like, I don't know. It's a wild subject because I've seen it so many times over the years, and it's always like the same thing over and over again. Is like you said, it's not a new thing because there have always been compared to certain things. Like, for example, Bitcoin was a huge one in the fund in 2017. Why would I invest with you guys if I could have just pulled all my money out and bought Bitcoin? Like that happened over and over again. And once again, at that time, funds couldn't own Bitcoin. So that was the same thing that was going on. Then 2020, well, my grandson's grandson bought the bottom here and they're doing great and you're not, like that was also another thing that happened. So it's like, you really have to like kind of laugh it off and understand like these if your investors are actually knowledgeable and they understand finance and they understand investing and you've done your job well, they understand that like conversations like that are stupid. They really don't matter. And most of the time, like those people who made the money, like yes, anybody can buy, like in 2020 when the market crashed, anybody could have bought any stock at that point and made money. What did you do in 2021? What did you do in 2022? And I'm not saying like the S&P 500. I'm saying the individual stocks. Like Boeing, people bought that in 2020 and made some money. It gave it back. Like there's a lot of things out there that made money that gave a lot of that money back. So, but who didn't give much of that money back? Well, that was people like me. That's the people who are actively trading. That's the people who are in and out of the markets tactically. Like, so once again, it's a, what does your money look like over 10 years with a actual investor? Like that's going to look much different than what did your money look like for 2 weeks with my nephew over here, like it's funny to like think about all of it, but it's just like it's so crazy and wild. It's like it's the craziest story really, because it's like what you brought up is something that I see so much, and I guess I never have really thought about it like deeply because it's just so insane. But I guess it does happen a lot more than I thought.
So I think one of your recent newsletters, you had this quote, right? Like there are good trades, there are bad trades, there are good trades that lose money and bad trades that make money. And I think the example that you bring of this energy fund. So had this energy fund had 7% in Apple, 5% in Google, 5% in Nvidia, the whole index weight last year, they would have massively outperformed every other energy fund in the market. But that would have been the bad trade that makes money, right? And
Mhm.
that's really not the kind of fund you would want to be invested in if you are looking for energy exposure. But right now, what you're seeing is every fund manager wants to be a tech fund by
Mhm.
default, just because you have to own the S&P. And I'm sure it's creating all sorts of distortions in the market, and especially in the professional money management space. And it's just incredible to think about.
Well,
I never seen anything like this before, or even read about anything like this before.
It's funny because if you think about it, like it's the thing that you know and I know, which is like, when did the cocoa ETF get delisted? Well, right before cocoa took off. It's like, when do markets, like, when does a sector usually top? Well, it's when everybody finally goes, well, this is the sector to be in. Um, Now, once again, it's like the same thing with energy. Could you know you could have said the same thing about energy at the bottom. At some point we'll be looking at energy and there'll be tech investors going, man, I should be buying energy. I can't believe, and they're going to talk about Exxon or something crazy like that. And that's going to probably tell us something. So once again, it's like, let's just see what we're learning from the market. Like, I like that angle of it. Like, what did we learn from the market with this situation happening? Well, for me, I'm learning that maybe tech is a little bit overdone. Do I need to do anything about it? Am I going to change my position? No, I don't have an exit signal yet, but I'm very comfortable saying, like, all the signals that we're seeing to get into these other sectors, those are going to start to be the outperformers soon. And we've seen the outperformance already. It's just probably going to continue. Especially in the face of, like, Powell continually talking about, the inflation being completely psychological, and when people don't believe in it, like, that's the craziest crap ever. Um, but once again, it's like, we look at these markets, and yes, they are incredibly psychological, but at the same time, money is flowing where it flows. So we have to pay attention to that. And it's obviously flowing into these inflationary sectors and inflationary commodities. And I would be very surprised to see them cut rates in the face of it. But if they did, that only gives us that's only going to make it better for people like us who are positioned like this already. So I think it's going to be an interesting year. We'll just end on that note. I got to get going, but that was a lot of fun. Let's do this again soon.
Yeah, absolutely.
Stick around
This
for a
was
sec.
great. Sure.